A staggering $68.1 billion in quarterly total revenue just hit the tape. Yet the underlying foundation is cracking. Advanced Micro Devices is fighting an absolute industry behemoth, but is AMD capturing real market share or merely surviving on structural overflow? Could a hidden trap entirely wipe out your portfolio gains? To answer this, we apply rigorous fundamental analysis. When you examine the massive $62.3 billion in quarterly data center revenue posted by the primary benchmark, the competitive scale becomes terrifying. Investors demand concrete evidence that AMD is securing a permanent slice of this $193.7 billion in annualized data center ecosystem revenue. This metric measures total expected yearly spending by corporations building massive computing facilities. At first glance, you might look at surging artificial intelligence infrastructure demand and assume AMD will automatically thrive. But when the primary competitor commands $102.7 billion in operating cash flow, the picture changes entirely. Operating cash flow tracks the actual cash generated by normal operations, proving if profits are real. AMD cannot simply exist as a secondary option against that liquidity. It must aggressively steal enterprise capital expenditures to validate its valuation. The golden rule here is that top-line illusion often masks structural market share deficits. This is exactly why your portfolio feels stagnant right now, because underlying market share dynamics dictate long-term wealth. Once you grasp this reality against that $102.7 billion in operating cash flow, your investing strategy will permanently shift. But does this mean AMD is outgunned? To understand why AMD faces a brutal uphill battle, we must look at the pricing power paradox threatening the sector. The benchmark competitor posted a Q4 gross margin of 75%. Gross margin shows the percentage of revenue retained after direct production costs, acting as the ultimate gauge of pricing power. On the surface, mainstream stock market analysis assumes AMD has room to undercut prices and steal lucrative clients easily. But they entirely ignore the hidden liability, which is a full-year gross margin compression of 3.9 percentage points for that very same industry leader. This compression reveals a structural ceiling in chip pricing nobody wants to acknowledge. Hyperscalers are scrutinizing skyrocketing hardware costs, severely limiting the pricing flexibility that AMD actually holds. If AMD tries to compete purely on price, it risks triggering a margin race to the bottom that destroys its financial stability. The real lesson is that ignoring a 3.9 percentage point margin compression destroys your long-term investing strategy. And this brings us to the real elephant in the room regarding global market access. The sector's dominant player recently issued forward revenue guidance of $78 billion. Forward revenue guidance is management's official estimate of sales expected next quarter. But that $78 billion explicitly excludes any data center revenue from restricted eastern regions. With global policy shifts neutralizing historically massive geographic sectors, AMD is forced into an exponentially more cutthroat competition for Western clients. Even with a stable corporate tax rate outlook of 17%, the geographic concentration risk remains immensely high. We also see the corporate tax rate ceiling capped at 19%, giving AMD some predictability, but that cannot solve the missing international revenue gap. When a major geographic revenue stream drops to absolute zero, competition for remaining enterprise budgets becomes lethal. Understanding geographic revenue composition matters deeply for your portfolio because unexpected policy shifts can instantly evaporate growth assumptions. Before we resolve how AMD survives this geographic squeeze, we must confront an even larger ecosystem threat. The market benchmark just executed an investing cash outflow of $13 billion, directed specifically at an emerging artificial intelligence startup. Investing cash outflow measures the hard currency spent on acquisitions to fuel future growth. This massive deployment of $13 billion in capital reveals a ruthless strategy to solidify proprietary software moats. For AMD, this is a glaring warning sign. When competing against an entity that also delivered a total shareholder return of $41.1 billion through buybacks and dividends, pure hardware innovation is not enough. Total shareholder return combines stock price appreciation and dividends paid, showing the true wealth handed back to investors. To combat a competitor returning $41.1 billion to shareholders, AMD must prove it possesses liquidity to make aggressive acquisitions. The golden rule here is that superior silicon always loses to a superior developer ecosystem. However, the most immediate danger to AMD is quietly hiding on the balance sheet, signaling a potentially catastrophic demand plateau. We are currently witnessing a massive stockpiling of next-generation compute components, with total industry inventory sitting at a bloated $21.4 billion. Total industry inventory tallies the value of unsold goods waiting in warehouses. On the surface, bullish analysts will tell you this is preparation for an upcoming product cycle. But when you uncover an inventory year-over-year surge of 112%, the narrative twists violently. This accumulation vastly outpaces underlying end-user deployment and physical facility construction. If this 112% inventory buildup outstrips physical infrastructure capabilities of hyperscalers, the entire semiconductor sector faces a sudden oversupply reckoning. Any slight hesitation in enterprise demand will disproportionately punish secondary market players first. AMD will be heavily judged on its own inventory turnover efficiency, as swift inventory write-downs could obliterate its quarterly earnings. Tracking inventory velocity acts as the ultimate early warning system for demand saturation in your fundamental analysis. To understand if AMD can survive this looming oversupply, we must look at the terrifying innovation arms race redefining the technology landscape. The competitor's research and development spend of $18.5 billion sets an impossibly high financial floor for remaining relevant. Research and development spend represents the direct capital burned to invent future products. Many retail investors believe AMD's engineering talent alone can overcome deeper pockets. But a research and development year-over-year surge of 43% from the market leader shatters that illusion. AMD is forced into a brutal capital expenditure cycle, where it must match this 43% surge in innovation spending to launch viable alternatives. Every earnings call now transforms into a strict referendum on capital efficiency for AMD. The company must achieve architectural parity without dangerously degrading its cash position or taking on toxic leverage. The real lesson here for your value investing approach is that innovation without capital efficiency ultimately leads to shareholder dilution. This brings us right back to our original opening question. Is Advanced Micro Devices truly capturing sustainable market share or merely surviving on structural overflow? When you combine the terrifying $21.4 billion in industry inventory bloat, the brutal margin compression dynamics, and the massive ecosystem acquisitions by its rival, the reality is stark. Proper stock market analysis shows that AMD is executing brilliantly as a secondary supplier, but it remains fundamentally boxed in. The ultimate verdict is that AMD cannot win a sheer dollar-for-dollar spending contest. Its survival depends entirely on breaking proprietary software moats while fiercely protecting its own margins. I believe that within the next 2 to 3 years, the sheer weight of undeployed hardware inventory will trigger a brutal sector-wide margin collapse. This impending collapse will force AMD to either launch a revolutionary software acquisition or face a deeply painful valuation reset. But I want to hear your take. Do you think Advanced Micro Devices has the ecosystem strength to permanently disrupt the industry leader, or are they destined to remain a distant second? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.